I am here with Matt Cwiertnia. He is the head of private equity at Ares. Matt, thank you so much for joining this morning.
Thanks, Dani. Happy to be here.
So the environment we're in right now, about $250 billion worth of deals announced for this industry so far this year, up about 23% compared to last year. It's from a low base. So where are we? How far away are we from normal right now?
So I think the deal market is going to continue to improve here in the back half. I do think it's been slow. I think 2022, 2023, and the first half of 24 has been slow as rates have come up and people have adjusted to that. But I think whether it's here at the conference or talking to limited partners, our customers, look, I think people want money back in the private equity business. Investors want money back. And I do think the drumbeat is getting louder for that. And with that, I think GPs, like ourselves, are going to be looking to sell assets. And I think deal flow will pick up here back half of 24 and into 25.
When that deal flow picks up, because we have seen some exits, but it's been the really high quality, the stuff that you can find a buyer for. So what does it look like when it picks up in the fourth quarter? Is this going to be painful for folks?
I do think what you referenced is right. I do think the high-quality companies, the companies that are growing nicely, I think they have lots of alternatives. I think it is that second tier of companies that isn't growing as well, and there's been price discovery about that. So I do think there needs to be a bit of a meeting in the middle between buyers and sellers on some of those second-tier companies. But we expect that to happen. Again, if the LPs are really asking us for cash back, I think that's across the portfolio, not just with your best companies. And so GPs have to look at what is the market price, for some of these companies. And I think that will help deal volume to pick up here in the back half that include that kind of second tier of companies.
Well, a lot of these companies were bought when rates were low, valuations were quite high. So that price discovery you're talking about, I really want to get into what that price discovery actually is. Are we talking about big discounts, slight discounts? What sort of things are we actually going to see in terms of price in this market?
Sure. I think that it really depends on the growth rate of the company. So a lot of people ask, hey, is the deal volume going to get much better when the Fed cuts rates or the ECB cuts rates like it may do here shortly? Well, I don't think it's really as rates driven as it is growth driven. So the question now is, if I'm trying to sell a company that's growing at 20% a year, I think that market and the opportunities for exit is wide open. If we're talking about a company that's growing 5% a year, I think that becomes more difficult, and I think you would have to take potentially a bigger discount than what you might have bought it at in 2021. So I think that's where a lot of private equity firms are focused, is really, can I grow my companies? Can I grow them faster than the industry rates? Because that's how I'm going to get the best price overall.
Right. Well, one exit option that is frozen over, iced over, choose whatever metaphor you want, is IPOs.
Yep.
But this is a stock market that is trading at record highs. I could easily conduct a thesis that says now would be a great time for IPOs. Look at what the public market is doing. It keeps going up and up and up. Yep. So what's going on?
So I do think there's been a big shift over an extended period of time of money from the public markets to the private markets. So there's a lot of that discussion that's here at the conference, whether that's private credit, whether that's private equity, et cetera. I think some of that has really been the smaller cap and the mid cap IPO space has really been taken over by private equity, broadly speaking. So now when we're a private equity firm and we focus in the middle market, when we're thinking about taking a middle market company public, we have to think about, can we take it public and can it have a relatively steady trading price and volume over an extended period of time, usually 2 or 3 or 4 years, for a private equity firm to sell out of the company? Can it have that steady backdrop with which to sell shares? And what we see is a lot of volatility. So we see a lot of volatility in the market up and down. There are a lot of forces, there are a lot of money flows that I think have made that small and mid-cap public area more volatile than it was 10 or 15 years ago. And I do think then the public scrutiny for CEOs, for companies, I think it's made it more challenging to do IPOs.
I mean, the public scrutiny has always been there, though. So what's different this time?
I do think it's the volatility. I think it's the steadiness. So when CEOs and companies went public, there was a anticipation that I could grow my company and the stock price would stay relatively moderate and grow over time with the earnings of my company. today we're seeing stock prices go up and down fairly significantly, sometimes
that
on no news.
A temporary phenomenon, do you think, or is this a broken market that is not coming back?
So I think it's a changed market for sure. Whether it's broken or not, I think it's changed. I do think this is one of the reasons why the private markets have become more attractive, especially in this middle market or the mid-cap range. I think companies, CEOs, even shareholders prefer that less volatility and staying out of the public eye for longer. And if you have a number of liquidity options that are not just going public, which I think private equity does, I think then you're going to see more people stay in the private markets and not lend themselves to that kind of scrutiny.
So this reminds me of a criticism that I'm sure you'll have a certain feeling about. I was with Cliff Asness a few weeks ago, who has this criticism of the private equity sector. He's a public equity guy, make of that what you will. But he calls what you do volatility laundering. This idea that your returns are outsized is just because you've masked over the volatility that is in public markets. And at the same time, basically what you have is just leveraged public equities, and that's the only difference. Tell me why he's wrong.
Right. So it's a great question. We get this a lot. So from my perspective, I actually believe the private markets are more consistent in terms of their valuations because the companies are being more consistent in their results overall. Right. I don't think there's as much volatility. In the public markets, I think there are a number of factors that can affect stock price that go beyond just the company performance. And we see that in terms of money flows, in terms of mutual funds, in terms of ETFs. And yes, in terms of meme stocks or other things that have played to the small cap universe.
Just quickly, Matt, on that, I mean, your conversations with CEOs, presumably there's been this desire to not have the volatility of public markets for a while, but what sort of tone are you hearing from them? Is it different when they talk to you about IPOing and maybe the fear of becoming a public company?
So for sure. I think as a CEO, what you're looking for is a fiduciary of your company, which includes not only your shareholders, but many employees, many other constituents that you're taking care of. And so when you're thinking about all of those and you head into the public markets, what you're trying to do is to not have this huge volatility in the stock price, which, especially when it goes down, can cause some concern among your employee base, maybe among suppliers, among other people. I would rather stay in the private markets with the consistency of at least my valuation, my destination, and I can talk about how our company is doing and hopefully succeeding and adding value to everyone under that fiduciary banner, rather than having to deal with the latest news of whether my stock went up or down 20%.
Right.
So we for sure hear that.
Yeah, and you know that firsthand what that's like working for a public company, Matt.
We do.
We're going to have to leave it there. Thank you so much for joining us. It was really a pleasure speaking with you. That was Matt Cwiertnia, the Ares head of private equity.